Mergers and acquisitions, or M&A, provide a critical avenue for companies to grow rapidly, develop competitive advantages, increase market share, and boost efficiency. M&A deals have helped create some of the most popular brands, and active M&A players include Amazon, Apple, Meta, which is better known as Facebook, Blackstone, and KKR. In this video, we discuss what M&A is, why companies engage in it, what kind of M&A deal types there are, and the types of buyers that do M&A deals. So mergers and acquisitions refers to the combination of two separate companies into a single entity. A merger is when two companies that are similar in size agree to combine as a single entity with a shared name. In contrast, an acquisition is when a larger company acquires a smaller one, which then loses its own name and begins operating under the name of the acquiring company. Through M&A, the combined entity seeks to benefit from the strengths of each previously independent company and create greater value through the realization of synergies. For example, two competitors that operate in the same industry may have unique characteristics that, when combined together, create significant value for various stakeholders. In this way, M&A enables businesses to rapidly boost their value to potential stakeholders, including customers, suppliers, governments, employees, investors, and most importantly, shareholders. So why do companies engage in M&A? Firstly, M&A enables companies to expand into new markets and offer new products that would otherwise not be possible due to barriers to entry. Through M&A, the combined business is able to capture greater market share in its industry. Another reason is shared resources. When two companies come together as a single entity, they are able to share many core functions and processes, which can reduce costs. Cost reductions that arise from the combination of two businesses are called cost synergies. Now, synergies are a topic which we will discuss in depth shortly. M&A also enables faster growth for two companies by enabling them to leverage each other's unique strengths. For example, one of the businesses in an M&A deal could bring value additive resources such as new technology, exclusive customer relationships, and strong R&D capabilities, whereas the other business could bring operational strength through an experienced management team, an international footprint, and streamlined production capabilities. This could help the combined entity grow faster than if each of the individual businesses tried to build all of these capabilities internally on their own. Additionally, as two companies combine through M&A, they have access to greater capital since investors are more willing to invest in larger companies with greater growth prospects since they are considered less risky. Finally, M&A also reduces competition between companies that operate in the same industry and enables them to work collaboratively toward a common goal. Now, earlier we alluded to a term called synergies. Synergies refer to the phenomenon where the value and performance of a combined entity is greater than the sum of the separate entities operating independently from each other. There are two types of synergies: cost synergies and revenue synergies. Cost synergies refer to any incremental value created for a combined entity through cost savings. For example, two separate businesses may have separate R&D teams. If the businesses combine as a single entity, they may find that they need less people on their combined R&D team, which can cause them to reduce headcount and lower the overall cost of the business. Revenue synergies refer to any incremental value created for a combined entity through increased revenue. For example, two separate businesses may have related products that are complementary to each other and can enable the combined business to generate greater revenue by bundling these products and selling them together to their customers. This is known as cross-selling because each business is able to sell to a new set of customers that they previously did not have access to. Now, there are several types of M&A that companies can engage in. The first type of M&A is horizontal M&A. This is when two companies that operate in similar industries and likely compete with each other are acquired or merged together. An example of this could be when a chair retailer acquires a table retailer, which enables the combined entity to offer a more comprehensive furniture offering to its combined customer base. The second type of M&A is vertical M&A. This is when two companies that operate in similar industries but do not necessarily compete with each other are acquired or merged together. An example of this could be when a chair retailer acquires the manufacturer that it purchases chairs from in order to have more control over its supply chain and the design of its product offering. The third type of M&A is conglomerate M&A. This is when two companies that have virtually nothing in common are acquired or merged together. The main reason for such transactions is to enable the two companies to diversify their product offerings and enable cross-selling opportunities. So who are the buyers or acquirers of companies? Such acquirers can be placed into two broad categories: strategic buyers and financial buyers. A strategic buyer is an operating business that acquires other companies to add long-term value to its own business. This can be through vertical M&A, which is meant to find new customers or suppliers, or horizontal M&A, which helps to expand into new products and markets, reducing competition and increasing market share. Strategic buyers are willing to pay more for companies since they are in a position to directly benefit from the synergies that the M&A deal would create. For example, in January 2008, Amazon acquired Audible for $300 million, which was an important step toward enabling the company to continue moving into the market of digital books. This acquisition was highly complementary to Kindle, which was a portable wireless book reader that Amazon had launched just a year earlier. In contrast, a financial buyer is an investment firm that acquires other businesses from an investment perspective, where the primary goal is to generate attractive returns on the capital that the buyer invests into the company. Financial buyers can invest in various types of businesses and industries where they help to increase revenues and reduce costs of the companies that they acquire in order to maximize their return on invested capital. Compared to strategic buyers, financial buyers pay less for acquisitions since they do not directly benefit from any synergies unless they have an existing business that could benefit from being combined with the new business being acquired. For example, in February 2013, Dell Computers was acquired by Silver Lake, a US private equity firm, which took the company private at a total purchase price of $24 billion. At this time, Dell was a struggling public company, and going private helped it to reposition itself to become a leading industry player once again. If you enjoyed this video, please like and subscribe to our channel. If you're interested in pursuing careers in finance, check out the link to our training program in the description below. Our program includes dedicated interview prep, mentorship by current industry professionals, and direct career placement opportunities in finance. Thanks for watching, and we will see you in the next video.